step for any new trader at any level joining ETX is to learn the basics. Education and experience go hand in hand. This is the third class in a 4-week course that is presented each month to make sure our traders get off on the right foot. Now, this is our third class of our monthly training series. In this webinar, we're going to begin to look at how we interpret price action on charts and how to find entry and exit points by applying technical analysis. We will look at the basic lines that all traders should be able to place on their charts, including trends and support and resistance. Now, tonight's class is being recorded, and if you wish to see a recorded version of tonight's class, you can use the link you used to attend tonight's class, or you can contact customer support and they'll give you a direct link. So let's get started with class number 3. Now, in tonight's class, I'm going to be running some special presentations for you. These presentations are not re-recorded into the recording of the class. So if you wish to see these presentations separately, I gave you a handout that you can see on your screen where it says presentation YouTube link page. Just download that and it's just got the link to go see these on YouTube. Also, if you notice, I've also put together a handout called the ETX Capital Technical Indicators Guide. This goes over the major indicators, and you can download that now. There's no sign up, no registration. Just click the download button. It's yours, and you can use it as a reference guide whenever you'd like. Now, also in tonight's class, I might say security. I might say asset. I might say the euro. I might say Bitcoin. But I'm not really talking about any specific investment vehicle. We're talking about all publicly traded financial instruments. Similarly, I intermix the terms investing and trading. Typically, an investor takes a long-term position, while a trader takes a much shorter-term position. And since all of us are here through ETX, we're all traders. Now, tonight, the first thing we have to look at is understanding price charts. And a price chart is simply a graphic depiction of the current historical price of an asset. Because our brains, our minds, cannot make heads or tails out of a bunch of numbers. If I were to say to you, the euro is trading at 111.42, but it opened at 111.41 this morning, and at 12 o'clock it hit 111.42, and then at 1 o'clock it was 111.39, and then at 2 o'clock it went to 111.44, and then at 2:15 it was at 111.46, and it closed at 111.47. Could you tell me about any of that? Could you even repeat it? Could you visualize it? Could you actually decide whether the asset was moving up or down, and how it was reacting, or how volatile it was, or what the top and the bottom of it, the range was? No, we can't. Our minds cannot deal with that many numbers. So a chart is really a graphic depiction of all that I just said to you. And when we put it in a visual format, our minds can then understand and interpret what is happening. So charting is very, very important. It's not very difficult, but it is very important. Now, charts typically have several different display modes for displaying price. We go from the most popular, which is Japanese candlesticks, and candlesticks have been around since the 1700s. The candlestick charts were used by rice traders. It came over to the Western world and started becoming popular in the 1900s. But the fact is, very few people still use it. In fact, those days there was very few people trading. But it was a complicated method because in those days we charted by hand. And hand charting is time consuming. And therefore, most people didn't use candlesticks. With the development of computers and computerized charting and the growth of online trading, the markets went crazy for candlesticks. Online traders swear by candlesticks. I don't know why. I mean, they're good and they're reliable, but they're just as good as bar charts. Now, we have three main types of charts. We have bar charts, line charts, and candlestick charts. They all use the same pieces of information because price is price is price. The open is the open, the close is the close, the high is the high, and the low is the low. It's permanent forever data. So a line chart is the most simplistic of all types of charts. Actually, let's go over to a live chart and I'll show you this on live charts. Okay, here we have a line chart. Now, before we go on a little bit farther, I'm going to give you a sidebar about charts. In the old days, and I'll always talk about the old days because I don't like the new days. The old days, things like bar charts always, or line charts, always use the close. Just like moving averages were always based on the close, because you had a choice of the open, the high, the low, and the close. But these computerized charts and computers have given us too many choices. If you wanted to do a bar chart today, and the one you're looking at on your screen right now is based on the close, but technically, we could use the close, the open, the high, or the low, or we could use the high and the low divided by 2. We could use the high, the low, and close divided by 3, or the open, the high, the low, and the close divided by 4. Now, this is just my personal belief. I think it's all a bunch of hogwash. If everybody used the close, everybody would know what everybody was looking at. But there's just too many variations and choices offered to us that people might use. But you know what? What more information are you going to use if you put a line chart on here using the open, the high, the low, and the close divided by 3? And if you were to do that, what type of information are you getting? You're getting a line chart that doesn't really tell you anything. Now I can look at this line chart and put my settings right here, and I know at 1800 on the 19th that this asset closed at this price. So typically we use the close. So that's one little sidetrack. The second little sidetrack about charts that you should be aware of is the data feeds. To feed this data instantly to your charts is extremely expensive. And when you think that you have literally thousands of assets, all with the information being fed directly into your charting software, that's a lot of data. And all of that data feeds come from different providers. And you have to have contracts with each of these different providers, and they are expensive because you're getting up to the minute information, up to the second, pushed directly out to your trading platform. Now, when you're using ETX, your charts are instantaneous because we have to pay for the feeds anyway, because we've got to give you the quotes for the most recent price on the platform. The quote on the platform is the same price on the chart. So the charts don't cost any more to have the quickest, fastest data feeds possible. Whereas when you're using charting services, whether you're using free charts from investing.com or FX Daily or Forex Factory or TradingView, if you're using the free charts, and nobody's trying to bamboozle you, don't misunderstand me. If you look, when you sign up for the free charts or you sign up with your registration, they tell you straight out that if you don't have a subscription, that you're getting delayed feeds. That means Some of the feeds are a minute behind, some are 2 minutes behind. So if it's 11:59 now, or at 12 o'clock, you're getting the 11:59 data is going on the chart at 11:59. But everybody else that's got it faster feed is trading has the 12 o'clock feeds already. This is because there is a huge reduction in the cost of the feeds when they're not up to the second. Plus, all these computers and all of these people using charts have to be pulling this data off of the servers for whoever's getting the data put in. So like TradingView, everybody who's logging on and pulling this stuff is pulling all this data and all this historical data from the servers on TradingView. That's a lot of computer work. So even when you're using the $9.95 or the $5.95 a month or the $99 a year packages, most of them will tell you that you've got anywhere from a 1 minute delay to a 5 minute delay. So be aware of that. So you should always be using the charts to make your final decisions based on the ETX platform. So right now we are looking at, okay, I'm done with the sidebars, and we're going to go look at the line chart. It's a very boring chart. It doesn't give us any valuable information except gives us an overall view of how an asset has moved. Too simplistic, too basic. Okay. But if you just want to look at something real quickly and get some idea, you can get some idea. I don't know what caused it, but for some reason, the euro US dollar spiked right here from 112.24, 11244 all the way up here to 121415. So I wish I had a trade on, on the euro, but I'm not. Okay, and this is not trading advice. I just see it as we're talking. It's really gotten volatile and recovered all of its loss from earlier today. But this is the basic chart. From here we go to my favorite, and the one I've been using for a zillion years, and that's the bar chart. Now, this bar chart is exactly the same as the line chart. It's using the same data, but the bar chart uses the 4 pieces of data: the open for that period, the close for that period, the high for that period, and the low for that period. Now, those numbers are indelibly etched into history. Those numbers can never and will never change. So it doesn't matter what charting service you're using, whether you're leaving these charts and coming back, those numbers are always going to be the same, because we're looking at a 15-minute chart. I'm sorry, we're looking at a 30-minute chart. So at the beginning of each 30-minute period, that number goes on the chart. End of that 30-minute, that close is put on the chart, and the new bar is constructed. Now, what we get when we move from a line chart to a bar chart is we get to see a lot more information. We see a much better story about what the market's doing and what price action is doing. So each bar is based on the open, the high, the low, and the close. We're going to go back and learn how to put a bar on a chart, but I want to just jump over to candlesticks first, and then we're going to go back and actually learn how to construct each one of these. But then we go to candlesticks. Now, candlesticks not only give us a visual representation, they give us a color representation. And this is one of the problems, because candlesticks have very little to do with the color of the candle. Seeing an abundance of red isn't necessarily telling you to take a trade going down. Seeing a red candle next to a green candle doesn't also tell you anything. Candlesticks are all about the shape and the size of each candle. So for a candle, this is called the body. These are called the wicks. And candles are all about the shape and the size of the body and the wicks, and its interrelation to the preceding candle and the post candle. And of course, how it's reacting in the trend. Now, candlesticks are very good when you want to learn how to use all this. but it's a lot more complicated. So when you're saying you're trading from candlesticks, you're really not. You're using candlestick charts, but you're not using any type of interpretation using candlesticks. You're just using candlestick charts. So don't mix up the two, because a lot of the information about candlesticks is irrelevant. Knowing what a doji is, knowing what a harami is, knowing what, there are some main candles everybody should know, a bullish engulfing and a bearish engulfing, but these are candlestick patterns. Now, there are many ways that we can use candlesticks, but you have to learn them. And like I use them as part of my 3-step indicator trading series. And then I'm only looking for one specific type candle, and it's called an indecision candle. But I'm looking at where it appears in relationship to my support and resistance lines and my trend line. But that's only one of my strategies. It's a real basic strategy. But this is candlesticks. So these are the 3 types of charts. Now, this may sound like it's really basic information, but you'd be surprised how many traders don't know the difference. Now, why would you look at a 15-minute, a 30-minute, and a 1-hour chart? So we're looking at candlesticks right now in 30 minutes. If we were to change it to a 15-minute chart, we're going to get the same information. Price has not changed, and numbers have not changed. But what happens is, for that 30 minutes that we were looking at before, now we have 2 candles covering that period. So we get to see a little bit more information about what's happening, because now we have this candle and this candle, because these 2 candles make up the last half hour. But now we can see that what happened in the last 15 minutes and what happened in the 15 minutes before that. It gives us much more information about the most current time frame. If we were to look back an hour, we use a 1-hour chart. Now, this candle that we see represents 1 hour of trading. So it's the last 4 candlesticks in the 15-minute trading, or the last 2 candlesticks in the 1 hour, in the half-hour trading. But what it doesn't do is it doesn't break down. So we don't know, if we're looking at a 1-hour candle, if the price soared all the way up here 59 minutes ago and then stayed there the whole time, or in the first 15 minutes it moved up to here, and then the next 15 minutes it moved up to there. The last 15 minutes it moved up to there. We don't know that unless we're using it a 15-minute chart. So we have to understand and use time frames. And we should always be using multiple time frames, because the longer term time frame, and even a 1-day time frame, isn't too long, even though you're trading in a short-term period, isn't too long to take a look at what we want to see. My preference is a 4-hour chart. I'll use a 4-hour, a 30-minute, and a 15-minute. Now, a 4-hour chart is what I call an environmental signal. It's telling you about how that asset is moving over a longer period of time. So you can see down below on your charts, the time period being covered by what you visually see in the window. So we want to see how an asset's been trading in a longer period of time to help us make our decisions. Because we want to know overall environmentally, is this asset been trading up or has it been trading down? Not just has been trading up in the last half hour. We want to know if it's in the middle of a long-term uptrend or a downtrend. Like here, we can see the euro was in a long-term hardcore downtrend. And now it tried to recover, wasn't able to, and now it's continuing, and it looks like back into its downtrend. So we know there's weight on the euro US dollar to go down. It's not looking to climb. Okay. So that tells us something environmentally about the euro. Then by reducing that time frame, we then see how the euro has been trading in a shorter period. It's still a long time, but we can see it back to the 17th, we can see it back to the 16th, back to the 15th. So we can see that it's still in a longer time, a shorter period. We see it in a downtrend, but we see that downtrend looks like it's been recovering, and we see we have actually an uptrend forming. So that tells us a little bit more about how the euro is performing in a shorter term time frame. So it looks like for the last 24 hours, we've had a little bit of a rally in the euro. And then if we were to drop it down to a 30-minute chart or a 15-minute chart, okay, these are where we would make our entry and exit decisions. Okay, the 30-minute chart is where we will make, or the 1 hour chart, I'm sorry, is where we would make our decision whether we would want to buy or sell the asset. The shorter period chart is when we would make the ultimate decision of where we'd want to enter the trade, where we'd want to exit the trade, and where we would put our stop loss on what the swing of the market is, because we need that in a shorter term time frame. Some people go all the way down to 5-minute charts. But understanding the use of time frames on a chart is very, very important. So let's go back to my PowerPoint and let's figure out how to construct the candlestick and how to construct the bar, so you understand what makes them up. Okay, so a bar chart is made up of these bars. Now, in the old days, bars were always black. Today, you can actually color code the bars, and you can have black bars for bull sessions and red bars for bear sessions, just like you do with candlesticks. I still only use black bars. Okay. What you do is at the open of the time segment, you put a dash to the left. At the close of that time segment, if you're using a 1 hour chart, put a dash to the right. You then go put a dot to the highest price asset traded during that 1 hour time frame, and a dot to where the lowest price that asset traded in that time frame, and connect the dots together, and you've created a bar. Now, if you climb up the ladder from the open to the close, this would be considered a bullish session, because the bulls were in control and they closed higher than it opened. On the other hand, if your open was here and your close was down here, so you stepped down the ladder, that's telling you the bears were in control, because that was a bearish session, because the close is lower than the open. Now, on a candlestick chart, we have the same numbers, because numbers are numbers and numbers. We use the open, the high, the low, and the close. The only difference is how we put it on the chart. So for a candlestick, we draw a line across at the open, and we draw a line across at the close, not dashes. We also put a dot at the high and a dot at the low. We connect the dot to the bar, a dot to the line, then we connect the lines together. This forms the body of the candle. That's the difference between the open and the close. The difference between the close, or the difference between this line across and the high, this is called a wick or a shadow. Now, if we step down from the close to the open, if we step down from the open to the close, we have a bearish session. If we stepped up from the open to the close, we have a bullish session. Now, I'll try to explain this to you because it's something you need to understand. It's not complicated. It catches some people by surprise. Hold on a second, my marker won't turn up. There we go. Okay. Now, If you notice, the candle on the left is empty. It's white. It's clear. The candle on the right is black. Today, we have bullish candles in green and bearish candles in red. But back in the old days, if you were charting candlesticks by hand, you would draw your line across, your line across, your line up, your line down, and connect your lines to fill in the body. But because 30 years ago, 40 years ago, there wasn't magic markers. We didn't have we weren't using computers, and you were carrying around, and we hand charted everything. We walked around with books full of graph paper with all of our charts on them. And you'd use your pencil or your pen, whichever your particular, I use a number 2 lead pencil. And so you have one pencil in your hand. If it was a bullish session, you just wouldn't fill in the candle. If it was a bearish session, you would just take the side of your pencil and fill it in. So in those days, these were called black and white candles. Today, we have the red and the green candles. The reason I mention this is if you're going to learn to use candles, a lot of the candlestick patterns are named after, or the explanations are based on black and white candles. So we have some patterns like 3 black crows, 3 white soldiers. That's where they come from. But the fact is, you could make candlesticks any color you wanted. Let's show you. Okay. Because on your candlestick charts, just go to your settings, we could change these candles to purple and orange, to chartreuse and pink. It doesn't make a difference as long as you know what color is bullish and what color is bearish. So if we want to change these right now to whatever color that is and to whatever color this is, and change our candlesticks, look at that. We changed our candlesticks. As long as you know which ones are bullish and which ones are bearish, you're perfectly fine. Now, I forgot which ones I changed to where. Okay, here we want to change it back to red. And here we want to change back to green. And we've got our candlesticks back. Okay. So, the reason we need to learn how to read and use charts is because we also want to learn to use technical analysis. Now, technical analysis could be called chart analysis because simply by looking at this chart, we are using technical analysis. Simply reading a chart is part of technical analysis. Then any lines, anything you read about technical analysis, all is done on a chart. All technical analysis takes place on your charts. So whether you're adding trend lines or support and resistance levels, or you're adding indicators like MACD, like you see down below, or even just adding simple moving averages onto our chart, they're all parts of technical analysis and they're done on your charts. So in order to do this, you have to learn to set up your charts and use your charts. Now, today is all pretty easy because you can find all the primary technical tools right here. You don't have to do any calculation. You have to do anything. You just click on the button. So if we want Bollinger Bands, put on our chart, we click on Bollinger Bands, and lo and behold, it's on our chart. Now, Bollinger Bands are one of the few indicators that are laid on over top of price action. Most indicators are laid on underneath price action. So let's go to RSI. And you can see that's been dropped down below where MACD is also. But all of this is a matter of using charts. But of course, we're getting very advanced right here. Don't need to be that advanced. We can get rid of all of this stuff. Because some of the basics we need to learn is how to put a trend line on our charts. Because a trend and a trend line are the first things we use to start interpreting price action. And now trend lines are one of the only really rule-based indicators out there. So actually, let's go back over. This is the same chart. Now, a trend line is drawn by connecting 2 points in common without letting price go through those points. And you locate your significant swing low and then pull it forward. But you don't have a valid trend line until it has 3 points in common. Now this trend line happens to be very valid because we have one touch here, which is where we started. This would give us our second touch, where we would have been able to lay the ruler on. And look at this, we have a third price touching that trend line. That makes that a valid trend line. Now, sure, we've had a big rally up in price. So we could also have at this point, you can have long-term, medium-term, and long-term trends. So this is a longer-term trend line. But if we wanted to take in consideration this crazy surge up and make some decisions on it, we could find a trend and extend it forward. Remember, the rule of the trend is no price can break that trend line. And we also happen to have 3 points in common, which is very surprising again. 1, 2, 3. If I were to put the trend line on here completely correctly. Okay. Now, that's very unusual because most time you can draw a trend line through 2, and you have to wait for sometimes quite a long time for that trend line to be validated. But now we have an interpretation of the longer term uptrend and the short term uptrend, which would help us do some type of price analysis. Okay. Now, when we move those trend lines and move back to a longer period, we can start to see a little bit more about what's happening with price. And if you notice, those trend lines hold quite well as we change price, but it was quite difficult to see them, and it would have been very difficult to draw them on in this longer term time frames. That's one of the reasons we can use a shorter term time frame, because they're still valid. Now, the next thing we want to go from our trend lines is to what's called support and resistance line areas. Support and resistance and trend lines should be on your charts no matter how you're making your trading decision. Because support and resistance are levels. First of all, you have to get them from what we call eyeballing. And we have a whole class on support and resistance. But it's where price in the past has had a difficult time breaking through or difficult time falling below. Once you've drawn them on your charts, you can extend them forward way in the future. So none of these prices in the red come from today or yesterday, day before. They're extended way back from the past and extend in the future, because whenever price moves back to that area again, those lines become valid. Okay. So we could see here, and it doesn't matter what time frame you're using, because those prices were important historically whenever price traded in this area. Now, when you have a rally we just had just recently, whatever caused it, I don't know, but we have this huge rally right here. And you can see price surge right through these support and resistance lines. Paid no attention to it. Now, price has moved up and is way here above this support line, broken through this resistance line. So our next critical point in the moving of this asset would be coming back up to the next resistance level or falling back below this support level. So this is helping us to determine what steps we should see along the way. Now, if you imagine support and resistance as imagine yourself in an elevator. The floor below your feet is supporting you on whatever floor you're on. And in order to move up, you have to break through that ceiling. Once you break through that ceiling, it becomes the floor under your feet, it becomes your support. And to move up to the next level, you have to break through that next ceiling. When that elevator turns back around, starting to go down, you have to jump through that floor, break that floor, because it's resisting you from falling lower, and it becomes your resistance, and your support is the ceiling above your head. As you break through that floor going lower, what happens? It becomes your next ceiling, and the next floor below you becomes your next resistance area. So as price moves up and down this elevator, this tells us these levels that you're having to break through in one direction or next. And this becomes part of technical analysis, but these are really the basics. Trend lines and support and resistance should be the basics of any trading decision. You know, there's an old saying, the trend is your friend. You never want to violate or trade against the trend. In the long term, you will be a much more successful trader statistically if you trade with the trend. Now, learning and understanding trends and development of trends is also very important, and we have a whole 1 hour class on that. But if you understand how a trend moves and how to verify that, because a trend is not, a trend line and a trend are slightly different. A trend is an overall directional move, and a trend consists of a push higher, an ease back, a push higher, an ease back, push higher, ease back, push higher. And in an uptrend, we're making a lower high to a higher low to a higher high to a higher low to a higher high to a higher low. And if these rules hold, you can also have a beautiful trend line across it because each low is higher than the previous low. So this helps us with price reaction. Now, if you stop to think, when you can find price in a real well-defined trend, these are times where price isn't as random as it normally is. And when you find price trending, first of all, for price to move in an uptrend or a downtrend takes a lot of work. Overall, price would like to sit in a congested area on its side. But ultimately, when price is moving up, you have lots of traders jumping in and pushing it up. So it's like a locomotive pushing forward. Okay? It's difficult to stop because you have everybody on the bandwagon. You have all the wheels going, the engines are going. So you have to stop and slow down the momentum before it's going to reverse. And we can watch for those signs. Same thing in a downtrend. That locomotive is going full speed out. And whenever the engines are running out of steam, we can see that in price action. Now, we then go from on our charts to go on to the next area, which is what a lot of people mix up with technical analysis. It is only one field of technical analysis, and that is technical indicators. So just like we had on here MACD before, okay, MACD is a technical indicator. It's one sector of technical analysis. Technical indicators are mathematical calculations that are put in some type of visual presentation, either below the chart or on the charts. But they're based on mathematical calculations. These are technical indicators. We also have what we call chart patterns or market structure. And these are based on historic patterns that we have seen in price, that when these patterns develop, they tell us something about price. And these go from everything from ascending wedge to a bullish pennant to a triple top to a triple bottom to a cup and handle to head and shoulders. Okay, all of these have rules about them. They're not complex, but if you stop to think that price is all dictated by market psychology, and these are the interpretations of how market psychology has affected price. And when you see traders reacting in a certain way, it develops a certain pattern on the charts. And we can use that to determine what's happening. So if we see a head and shoulders developing, we know that every time we've seen a head and shoulders in the past and for years and years ago, statistically, it's told us that there's a market reversal going on. Because price action is only, no matter what indicator you use, no matter what somebody tells you, the only thing that makes a difference is what the actual price is. And that actual price is based on a consensus between buyers and sellers. There's no law out there that anything has to do anything. If somebody jumps in and buys Bitcoin at $10,500, what's the price of Bitcoin now? $10,500. It's just on that person. Okay. So nobody can really predict where price is going to go because it's a matter of consensus between buyers and sellers. And that's all based on market psychology. And you say to me, that sounds ridiculous. But imagine, here's this big hedge fund guy or this big bank buyer. He runs the Forex department for one of the biggest banks in the world, and he makes hundreds of millions of dollars in trades. But you know what? Leaving the house this morning, he had an argument with the wife. He got a little bit delayed. After he left the house with the wife, the traffic was a mess. He had an argument with the guy next to him in the car, gave him the finger, got to work. He was pissed off and got into his office, turned on his computer, and he's in a bad mood. Well, guess what? That trade that he might have made, he didn't make today because he was a little bit late. And because he was in a bad mood, he just didn't care. And he didn't make that trade this morning. Because he's sitting there looking at his computer printouts and he's still having to make that decision of what to make. You're in a bad mood, you don't make it. There was an accident on the highway and he got to his office. Like, you say, that sounds absurd, but this is exactly what happens. Because it's all about buyers and sellers. Us retail traders are small potatoes. But you know what? If the London market opens and it's really bad weather or something crazy happened in London, there's a terrorist attack. Well, a lot of you're not, everybody's distracted by what's going on, and they're not trading. They're watching the TV news to see, what's happening with this, this terror situation or this kidnapping. It's all a matter. We can get distracted, and when we get thousands of people distracted, the markets can react differently. They've got holiday times, they've got non-holiday time. We got summer bank holidays. You can see when volume comes in and out of the markets, when people aren't trading, people are trading. You can see exactly what's happening because it's all in the price. So that price is just about the buyers and sellers. So we need to learn how to use our charts, how to look at them, how to read them, and how to interpret pricing. Some people don't use chart patterns. I firmly believe in triangles, which are sometimes referred to as pennants, okay, and flags, or pennants. I firmly believe in triangles. I like chart patterns. I don't use candlestick trading much. I use support and resistance and trend line a lot, okay. I don't use many indicators. Everybody decides what fits them best and what they believe in also to make up their trading decisions. But we have a 1-hour course in chart patterns. We have a 1-hour course on support and resistance. We have a 1-hour course on trends and trend lines. We have 1-hour courses on reading Japanese candlesticks. We have lots of classes for you because you're not going to learn all this in the introduction. Today, we're just trying, in each of these 4 classes in our introduction series, we're trying to give you some basics, some understanding, some food for thought. And on that note, I'm going to say goodnight to everybody. Thank you very much for joining us, and we'll talk to you on Tuesday. Have a great weekend. Bye now.